Affirm Holdings is a buy now, pay later company that helps businesses and consumers facilitate transactions that may not have otherwise happened. And so it helps both sides of the equation. And so it has a powerful tailwind lifting growth worldwide. So, should investors buy Affirm Holdings stock for 2025? I'm going to answer that question in this video, reviewing the company's revenue growth, its profitability expansion, its cash flow from operations, and then finally looking at the next few years, what the analysts on Wall Street expect for its future, and finally bringing it together with its valuation, measuring by the forward price to earnings ratio, and measuring using my discounted cash flow valuation approach to determine if you should buy this stock today.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Like I mentioned in the introduction, Affirm Holdings has generated significant growth at $2.5 billion in trailing 12-month revenue. That's up from over $700 million in 2020. The buy now, pay later industry is growing rapidly, especially as consumers are getting pinched. The money that consumers received during 2021, during 2020, all of that stimulus has mostly run out. But people still want to spend money. And one of the ways they can still spend money if they don't have money is utilizing buy now, pay later, paying in increments, buying that item today and paying it off over time. And of course, businesses love that because businesses that are selling products that are, let's say, $100 or above, they might miss out on a sale if the buy now, pay later option was not available. With the option available, somebody might buy it that otherwise would not have. And so you have incremental sales that are juicing the economy, and businesses like it, consumers like it, and so it's continuing expanding. Now, of course, you're probably thinking there is a risk here, and that's the risk that people borrow money on this buy now, pay later, but then they don't actually pay later, they pay never. And of course, that is a risk that a firm is dealing with, partly by having other investors put up the capital. Lenders have become increasingly interested in purchasing these types of loans. And this has been true not just for Affirm Holdings, but other types of loans like personal loan businesses like SoFi, like Upstart. They've been able to sell the loans that they originate to investors because investors are hungry for that yield. The interest rates that investors can earn for lending to individuals in these types of risky loans are in the double digits. So investors are looking for that yield because if you put your money, let's say in a certificate of deposit, you're getting 4.5%. If you put your money in a long-term government bond, you're getting 4.7, maybe 4.8%. Compared to some of these types of lending arrangements, you can get 10, 12, 14, 16, 18, even 20% return on your investment. Of course, you're taking a greater risk because the chance of default is higher, but investors have grown an appetite for these types of loans. They feel comfortable. Unemployment has trended low. It's moving higher, but it's at the lower end of where it's been in the last 50 years. People are still working, people are still spending money, and so they're taking a chance on that. Although, I don't know, there might be a reckoning because I'm noticing increasing default rates on various types of instruments. But thankfully, lenders still have an appetite to lend. When lenders turn off that appetite to lend and they say, we don't want to lend anymore, that's when it spells real trouble for the economy, the US economy and the world economy. But the US economy primarily is built on a lot of debt. And when that door closes to more debt, that's when the economy really screeches to a halt. And so hopefully this will continue, but keep in mind that risk. Affirm has done a great job turning things around on the bottom line. It was heading in the wrong direction, made changes in 2023, and those improvements, well, I should say late 2022, that started to pay off in 2023, and it reversed these worsening conditions, and its operating margin is almost positive now, negative 6.33%. If it continues in this trajectory, I wouldn't be surprised if in the next 6 months this is profitable on an operating margin over a trailing 12-month basis. The cash flow from operations is already positive, 21.7%. It's also trending in the nice direction, up from negative 20% in 2020. So the growth this company has facilitated has turned into positive cash flow for the company. And like I mentioned, Wall Street is bullish on this company's growth prospects. They expect its revenue to grow from 2.3 billion in 2024 all the way up to 5.35 billion in 2028. So Wall Street analysts expect Affirm's sales to more than double over the next 5 years, driven by the factors I highlighted in the beginning of the video, given that they're helping both sides of the equation. And so merchants are going to be interested in allowing Affirm holdings to be incorporated into their websites as a payment option, because they're going to want to facilitate more sales. They're going to want to allow their buyers to have that option to buy now and pay later, because it's not, in most cases, it's not the merchant that's giving the credit. It's Affirm and Affirm's partners that's giving the credit. The merchant is getting the money regardless of which one is the payment method used. And so merchants are becoming interested in Affirm. And then buyers like it because, buyers are impatient. They want to buy something. They want to have it now. They don't want to save up for it over several months and then make a purchase. They want to buy it today and then worry about paying it later, which I'm not here to uh, give personal financial advice on, no, you should be saving your money first and then buying later. Don't enter into those kinds of habits. Just stating the facts here. People like the option to buy things before they've saved up for it. So looking at the company's price to free cash flow as one valuation method, it's trading at a price to free cash flow of 53, near the highest it's been all year. However, when you consider the company's growth prospects forecasted by Wall Street and improvements in its cash flow and its operating income, it's a reasonable price for a company with its growth prospects. Similarly, when I look at the valuation based on my discounted cash flow model, it suggests an intrinsic value per share for Affirm at $81, but the current share price is only $65. So this too suggests that Affirm stock is a good value. So to answer the question, should investors buy Affirm stock for 2025? Well, I have it rated as a buy, so my answer is yes. I think this is an undervalued growth stock that makes sense for long-term investors. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.